Our next guest says he's expecting 25 basis point cut on Wednesday, but wouldn't be surprised if we got 50. Wells Fargo head of equity strategy Chris Harvey joins us here at Post 9. Chris's S&P price target, by the way, is 55.35. It's a little bit lower than we are right now. Thank you. It's good to see you. So I guess the risk if they don't go 50 is now that they could tighten financial conditions, which they don't want since the market's gotten so excited about all these cuts.
Yeah, I think that's right. I think there are bigger issues than whether they go 25 or 50, right? If you look at the inversion at the front end of the curve between Fed funds and the 2-year, it's 175 basis points. That's historic. That's the market saying you have a lot of wood to chop, you need to hurry up, and you need to get going. So really what we're talking about is, I'm not worried about 25 or 50, I'm worried about the path. Because the other thing with the path is people don't know how to plan, right? We're talking about 25 or 50. What do you think the average individual is talking about? The average corporation is talking about? They don't know. And what we heard from ISM Manufacturing is when you don't know, you slow down your activity, you slow down your purchasing, which is bad for the economy, right? And so the Fed really needs to give some communication and some path going forward where people can begin to plan.
They've said that they want to get to neutral, and they've showed that in their forecasts or dots.
Yeah, but the question is how? Are we going to see 175 basis points in the next 3 to 6 months, or are we going to see similar to what we saw in 04 to 06?
How can they know that right now?
I don't know. So, okay, let's take a step back. 5.3 on Fed funds, that's not a competitive cost of capital. Right? You can't find that at 2 years, you can't find that at 10 years, you can't find that at 30 years. You need to normalize rates, right? And that's a big normalization, right? Once we get to that normalization, now we got to talk about what the economy looks like and what kind of shape we want to put in the curve. But ultimately, one of the things we can't lose sight of is what credit spreads are doing. Credit spreads are still less than 100 basis points over comparable treasuries, which is a pretty good signal for the economy. And to your point, means that they don't have to rush, but at the end of the day, they do have to normalize. And that cost of capital is way too restrictive for what we see right now.
We spent a lot of time talking about fixed income, but you're an equities guy. So, and I noticed, you upped your target in April, but you haven't since, and it's below where we are. So why don't you believe the S&P has further to go higher?
So, David, the S&P might have further to go higher. One of the things that's keeping us on the sideline right now is that you have a lot of uncertainty. You have a lot of event risk. What we typically see before an easing cycle is a lot of uncertainty, people not sure the path going forward. In addition to that, what do we have? We have an election. And that election looks like it's a coin toss. And again, as people don't understand it and don't know what path is going forward, they slow down their activity. They slow down their purchasing, which often what we see in the market is more of a risk-off, risk aversion. And that's what we've been seeing until the last couple of days. And so we're a little bit cautious just heading into these big events.
And once they're resolved?
Once they're resolved, so there's a lot of talk in the marketplace that you sell the first cut. What we think is you buy the election. Typically, after the election, after the Fed, 6-12 months, equities are higher. We do see credit spreads being rather tight, and we don't see a recession. And if that's true, equity markets in 2025 should be pretty good.
So what is the defensive rally telling you? Month to date, real estate, utilities, staples, those are your best performers.
Yeah, so first off, we've been overweight utilities since the end of last year, and it wasn't a consensus call. It was really out of consensus call. So coming into this year, it was really beaten up sector, it was really downtrodden, and volatility was very low. So what it's telling you is, hey, there's a little bit more uncertainty in the marketplace. What it's also telling you is that, hey, we don't know the path going forward. Rates are coming down, and that's pushing things higher. As we get through these events, we think maybe that's not the best way to be positioned going forward, but that's something that we're talking about internally right now.